Stephan. I am the CEO and co-founder of a small but sweet fintech startup. We innovate from Frankfurt and Munich. Risk and Clio, risk and the Greek muse of historiography. And we like to explain jumps in asset prices. And before I start, oh, there you go. I will be mentioning Dieselgate later. Please be calm. That's all right. I don't mean any harm. There have been incidences in the past, just to say. And, well, obviously, this is going to be about finance. This is going to be about asset prices. It's going to be about stocks. So it's about predicting stuff other people would never want you to know, because they don't want you guys to know how they make money. So why am I standing here today? Obviously because I was invited. I feel excited being here. But there are other use cases for data analytics in finance as well. And it's something which I would like to show you about. So after I've shown this to you, you can check it out. There's a really interesting Kaggle competition out there. Unfortunately, it's too late for you to win the $100,000. So that's actually sponsored by one of the leading hedge funds in the US, and they're cashing out 100K on that, which tells you a bit about the significance of the stuff I'll be telling you in a bit. Obviously, we didn't really want to show them how we do it, but it's a different matter. So let's get started with a little bit of a recent example here from Munich, which was pretty much the greatest city ever. Hi YouTube, how's it going? So there has been something happening, well, but early this year. So that's the share price, 2019, first couple of days. If you were a shareholder, if you were an investor, well, things were looking bright and easy. 2019 couldn't start any better. And then the Financial Times comes up. And Financial Times published 2 articles about alleged fraudulent activities in the Southeast Asian operations of the bank. Now, alleged, so I'm just retelling what they said. But this, again, this was enough to cause that. So we see a dramatic drop in the asset price of Wirecard. After the first article, we had 14%. After the second article, we had 29%. So about like 40% gone in 2 days. So this is a bad thing, and that's precisely what the German regulator thought as well. And they banned short selling on it, because they were a bit concerned about retail investors getting left behind and the overall efficiency of the market. So if you're not in finance, short selling means that you really think that you want to sell something, so you actually borrow it to sell it. So you can buy it back later when it's really cheap. So that's how short selling works. And that's what people did. So if you talk about efficiency, we might just want to now put on our financial theory goggles. You know, sometimes it's good to have a PhD. Don't try this at home, but in theory, this is what we saw with Wirecard. Is basically what we should be expecting if everything's working well. But simply speaking, if I'm an investor in Wirecard and I read about, okay, there might be fraud happening, this is relevant information if I get this from a publicly available information, so no insider trading. So I will react, or I will be very likely do some kind of reaction, which would be in market terms, buy or sell a share. What we've seen there is basically so this is how the share price looked like without any colors. And this is what we see. So everything was happening, nothing was happening during normal days. We've got new information. Investors responded by more selling than buying, causing drops. And then back to normal when, you know, nothing happened. There's obviously a story following on to that. Well, let's just focus on those 2 things there, those 2 information. So obviously, now put on our data analyst goggles. In financial mathematics, we actually want to work with models. We want to come up with a way we can explain and see how those prices work, how we can use models to reflect them, and to continue doing other stuff with them. For example, price options. And this is one of the seminal option pricing papers by one of the grandfathers of the Black-Scholes-Merton option pricing formula, Robert Merton. And in a paper, he introduced something which he called abnormal vibrations in price, caused by the arrival of important new information. That's precisely what we've seen before. And he said, listen up guys, we need a different model for that. This is, well, from a theoretical point of view, this is a different kind of data generating process, and we should use a different kind of data generating process to reflect that. So in finance, this is how it looks like. So we have a geometric Brownian motion during normal days, and we have this strange red thing in the middle. So just to give you an indication, if you're not from finance, a normal geometric Brownian motion, so the mu is basically the drift, it's a deterministic drift. The sigma is the distance between the blue lines, and the B is a Brownian motion, which means that we actually don't really want to get any point estimates out of it, at least if we work with this kind of model. We just say it could be anywhere in between, that's random. But we want to focus on the big red one in the center. And that's the compound Poisson process. And this is a really interesting thing. It's been around for quite a while though, so Robert Merton was not the inventor. If you've got anyone in here owning a car, yeah, probably some, you've got car insurance, it's very likely that your actuary, your insurance mathematician, who priced your insurance contract, used some form of this model to calculate your premium. So this is how this is used. And suddenly we see a similar thing. We see people in finance using this in a way, using a model that insurance people use to simulate claims payments. So car accidents, for example. Well, in simple terms. And what we have here, just to break it down, so the N is basically a counting process. It's like, I take a period of time, and I have nothing happens, nothing happens, nothing happens, something happens, and I can count all the something happens in this period, and I have a probability. So I take the average of that. Every time I have something happens, I want to know what happens. So this is a different process. That's the Y. So it can be good, it can be bad, it can be both. I take all the y's, I take the average of that, and I have an expectation of what might be happening once I have something occurring. And what I get out of it is the probability of an estimate that something happens. And this is something we can work with. This is basically what risk is, a probability and something happening. And obviously what we can also do, which is also fun, is we can look, okay, this was the share price when the jump was. How long does it take for the share price to go back to normal? Now if we look at Wirecard, it's still waiting. But that's also information, isn't it? So this is a statistical model, and every time a statistical model is, we want to get as much observations in it as possible. And that's what I like about this topic, you know? A lot of observations. There you go. UBS, for example. So that's a great thing. If you do presentations on that, you can always check, you know, what just happened. Can I add new kind of examples? Here we have UBS earlier this year, 3.6% drop after a 3.7 billion fee by the French government because they help with tax evasion. It's usually a bad thing. That's another example. Snapchat, or I think it's Snap. So the CFO left unexpectedly, we've got minus 15%, but we can also have positive jumps. That's a great thing. You know, if you outperform analyst expectations, that's usually a good thing. And I, as an investor, would think, yeah, I might just want to buy, because that's what happens then. We don't have to look at individual companies only, we can also look at markets. So here we look at Dow Jones in January last year. So what we see here is inflation. People were really concerned about inflation and caused substantial drops. This is the Dow Jones, so this is really a big. This was a big thing last year. Was concerns about the U.S. Fed increasing interest rates. Now there was one rather prominent person sitting on the Iron Throne who was a bit surprised by what happened there. So this is what Donald Trump tweeted before this happened. So everything was going smoothly. Remember Wirecard, before anything happened, everything was going fine. Obviously, market were doing well, jobs, 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 and then suddenly something completely else happened. You know, people were concerned about inflation. And Donald Trump didn't like that. Now, this is, I actually did a presentation, basically half of a presentation only on this slide, because this tells you really quite a lot about, in general, using social media, and in general about market sentiment, because Donald Trump tweets this to his target audience, but this does not necessarily have to be the market. So we have to be able to distinguish that. And this tweet on the right-hand side, I think this is just a great sum up of what why you guys are actually listening to what I'm telling you, what I'm saying. And we've got Dieselgate. You know, don't really want to talk too much about that. The only thing I want to show you is that what happened back then was basically only about Volkswagen. However, what we could also see at this very date in 2015 was substantial drops in the share price of BMW and Daimler as well. Because investors, they did this thing. They made an assumption that what affected Volkswagen as an automotive company could also negatively affect other German automotive companies. So we have a peer effect. So that should be it for the moment for observation. So we have other examples, obviously, lots of examples. Elon Musk tweeting, that's a classic. Facebook data scandal, that used to be a big example on older versions of this presentation. And now that we've added some observations to it, we can start the data analytics. Go bananas. There you go. So this is basically, I've just rearranged the jumps a little bit. So we've got banks over there, Wirecard, UBS. We've got automotives over there. But with markets, it's always a bit, Snap is in there. Those companies are not in there. And we've got social media there. So we can cluster this as well by markets. And we've got all those different jumps. And one way to do this would just take the average of that. This is actually what Robert Merton said in his 1976 paper. Just take the average of the jumps, and you have a decent observation. But I can tell you, I'm not the best kind of car driver, I'll tell you that. And if you guys, if my performance would be reflected in your car insurance premium, would be a bit great for me, but unfair for you guys. So same thing here. So, but we want to drill deeper. We want to know how to properly cluster this, apart from average effects or stuff like that. And here we have the words, we have the news, we have the background. Why did companies? Clicker's not my best friend. Why did this happen? And how can we use this to actually make this possible? And who in here has got some experience with natural language processing? Ah, brilliant. You guys have heard about topic models for everyone else. So topic models is basically for me to collect raw data, raw information, text-based information, and see where I can put them together based on recurring similar words. The problem is, what I have to tell the model is how many topics I want to get out of it. How many of those groups do I want? There are approaches where you can leave this as a variable, but in production you might want to be on the safe side. So this is a bit of an issue. And the same thing goes with labels. So it's simple and straightforward to say Dieselgate is a label, but so what we work at RiskClear is we are thinking about terms like, so what if a black swan happens? What if we have an alien invasion tomorrow? We have never seen this before. Suddenly we have an alien invasion. Rest assured, there will be an impact on financial markets. How can we build a model that can reflect this? And this is what I want to show you now. So we don't have labeled data from the sense that we know this is fraud, this is not fraud, this is Dieselgate. This we try to derive from the information itself. But the one thing we know is, we know what is relevant and what is irrelevant news. And we know this from, we saw jumps. We saw people respond to it in the market. Market sentiment, not text sentiment. I can write you great text with a great sentiment score. The market wouldn't probably care about that. We look at market sentiment here, and this is precisely what we get out of it. So we have something of a label. So how does this look in real life? So this is in German. So this is the day before the Financial Times article, Google News. So that's the thing. That's the articles that came up. So obviously, it's a Wirecard released an API management and developer portal. Doesn't cause jumps. So investors, well, they kind of like it. I like it. I'm a developer. I kind of like it. Would I buy shares because of that? Different matter. This is how things look like the day after. Yeah. Yeah. A bit different. So what you can also see is you have a lot of repetitive stories on. Obviously, you've seen drops in share prices. You can also work with that, but then you want to dig deeper. You want to know the reasons for that. And the great thing is, beforehand, we didn't know how many topics, how many labels we should assign to it. Well, in this, we can do topic models just on that, what happened on that very day, and what we get out of it. There you go. We can get the topics out of that, and suddenly we have, well, we've seen the largest I've seen so far is 4 topics. So you would require 4 topics for one day. And then you get quite decent structure of it. So this is an example where you can say, okay, obviously a lot of stuff happens with the fraud thing. Obviously some happened, so they announced preliminary quarterly results that day, really bad for them, that the other thing happened. But so you can do this clustering, and the great thing is, so you can do a topic model on a day basis, given that you know that this day is really relevant because you know something must have happened because you've seen the job. You take this then, this information is something completely different to work with than the other kind of information. And then you can cluster with that. And one way to cluster this, I don't really want to go into detail, would be, we've seen it in the previous presentation, you can use an autoencoder on that. I mean, you get arrays of words, and this would be a back-of-word approach. You get arrays of words, that's an input. For every single day, for every single company, you get inputs. You can work with that. Suddenly, you can create your own labels using a deep learning architecture without having to worry about the number of topics you're working with. Yeah, AI is fancy, I know that. But the great thing, so this is a Bayesian updating approach. So this is probabilistic, meaning every new day that is added to the model means that the model can readjust itself. So this is self-learning by seeing new observations. Just kind of cool though. That's the kind of AI I prefer, but then again, I'm a bad driver. So a bit more technical. What we can do. So this is supposed to be a decision tree. It doesn't look like one, but try to fit this on this format. It's a challenge for itself. The great thing about the compound Poisson process is that it's additive. The moment that I can assign probabilities to effects, I can subcluster them. That's actually a problem in option pricing, and it's ongoing research we do. But what we can do is that we can say, okay, we have a jump. Okay, what caused the jump? Let's check. So this is actually a recursive Bellman optimization problem, if any nerds are in here. So great stuff. So what caused the jump? Was it idiosyncratic? Do we find anything on the company? If yes, we can check whether we can do the clustering thing with topic models. No, we haven't found anything. So maybe it was because Trump started a trade war with China. Might also affect my share, but I will never find anything about my share, Facebook or Snap, in the media about that. But I will find, trade war in China. So let's check this next. I did find something, I didn't find anything. So let's check next. How about my peers? So, what about, Daimler? Suddenly I find Volkswagen to be relevant for Daimler shares. If I just look at Daimler, I see the jump in Daimler, I go this way down, I do my little decision tree, and then what I want to optimize is the number of jumps I can explain. Is it bad to have jumps that I cannot explain? No. The model learns. What happens today, what I cannot explain today, is my explanation for tomorrow. And once in a while, it's good to know when something really new happens. Alien invasion. Doesn't mean that I want to have an alien invasion coming up. Sorry, get carried away on that one. So here this is where we started. And this is where we end. So we literally used AI to add colors to this slide. That's what I like about data visualization, to put it that way. It's all this effort is about adding color to it. But we have, for every single color, we have the effect. And we can assign the effect to it. Effect to color, and suddenly we have the subclustering. And now let's abstract away from that. And we are in a statistical model. So we use factors. So factor investing in finance would be I look at markets, I look at all the events of banks, and what they have in common, because they are banks, for example. That would be random effects. You've seen Snapchat, they had an average share price of $7, so you see 20%, 15% jumps. You wouldn't find jumps like that with Wirecard with like 150 euros on average, something like that. So you can take this into account, and then what you can also take into account, that every single time you see a bank have news with respect to fraud being announced, or fraud in general being announced, rest assured that there will be an effect, because fraud is really expensive. Why do we know this? Because we've seen it in the past, we've learned it. Risk-lio, Greek muse of historiography. So this is obviously a gross oversimplification. You need to add a lot of more data in it to get the proper results. But that's what we're here for. Don't worry about that. Let us worry about that. Put it that way. So this is basically the idea. What we can also do with that. So a question that usually comes up is, yeah, but you're just explaining the past. How can you make predictions? Well, we are working in a conditional probability space. We have seen top words co-occur in the past with jumps. We can listen in real time to news feeds. We can see similar patterns coming up. And we can label that because we have seen what causes jumps in the past, and we can make a prediction on that. Obviously, that's a bit more complex than saying, Stephan will have a car accident tomorrow, but there's no actuary who's thinking that way. They'd be thinking, yes, Stephan is probably more likely to have a car accident because he's just not that well trained. Or he's been living in the UK and, it's like left hand, right hand, different matter, don't get me started on that. So this is how you can make predictions as well. Obviously, the updating, that's what you've got on the right-hand side. And on the left-hand side, this is basically the Bayes theorem. Nothing fancy about that, apart from the pictures. Sorry. So back to why I am here and why you should care. Brilliant. So I might just want to take the 5 minutes for the Q&A just to tell you why this might be relevant for you, if that's fine with you guys. If you've got any questions, fire away. Apart from that, yeah, go ahead.
How do you distinguish between jumps and normal market vibrations? Maybe you explained it already, but I maybe didn't get it.
No, that's so what we use. So there's a concept. So obviously quantitative finance. So they have there's the idea. So that anything that is beyond a certain threshold, for example, 1 sigma standard deviation, statistically speaking, this will constitute as a jump. In this very simple example. Obviously, you have a lot of noise in there as well, so you might want to go with 2 sigma or stuff like that. And then you label it. You look at, okay, there we have a big jump, a less big jump, and then you go down with that. And you calibrate it. So what you can also do with that, and that's the great thing is, so this is basically what you're talking about, is how to get the P of the jump. You can calibrate this as well, using Markov chain Monte Carlo methods, once you have it all set up. Know precisely where your label, if you keep this constant and you optimize that then. It's a bit more computationally expensive, but this is how you could actually, so what we want to sell as well, we're not there yet, is those actual thresholds. What is a jump, what is not a jump? Calibrated on news. And you can use this, thanks very much, brilliant question indeed, for option pricing. That would be a use case for option pricing. So what is a jump, what is not a jump? Any other questions? Go ahead, sir.
Somewhere in a very big company, there's probably a guy sitting there who tries to reverse engineer what you do and sneak magic words into their press releases to make you expect upward jumps.
Yes. You're right. That's an endogeneity problem, and you're totally right about that. And usually, that's also a very good comment. That's what I tell people. That's the kind of question I like to ask people who are working with NLP on social media. What keeps me from posting hundreds of tweets saying this is the greatest product ever? What's keeping me? And that's the thing where you actually have to be careful and very mindful about the sources you take. So we take newswire sources, the kind of stuff we expect traders to look at. We take official company filings, for example. So ad hoc filings, stuff like that. We look into that. So this is what we call this actually the double spam filter that we are using. We are not looking at social media or anything you can tamper with as easily as I just said. So this guy sitting there, we wouldn't look at any media announcements or stuff like that, because this is obviously biased. So you always want to look at something the people look at, you want to emulate, which would be traders.
But the guy, he can design the press releases, and much of the text that the press office writes turns up in the news feeds like word by word. Because people are really lazy.
Yeah, you're right about that. But then again, if I mean, obviously, what you say is an endogeneity problem. What I also like to say is once we are there, that we have trouble with this kind of problem, the model has become so big and so good that people actually start paying attention to it. That I would really like you to ask you to invest in us, because once we are there, that's great. For the time being, obviously, there's an issue with that. But this is precisely the kind of issue, that was precisely the kind of problem with the Financial Times example. So what's the big thing with the Financial Times? It has a reputation. And it has a reputation to lose if they just, mimic, if they just parrot away what people tell them, what companies tell them. They are not their media outlets. You buy Financial Times magazine, you look at Bloomberg stuff. I'm not really want to make any like commercial here, stuff like that. But you're not paying for this kind of news feeds to have them tell you how awesome stuff is, because the marketing companies tell you that by themselves. But you're right, this is an issue, this is something you have to be aware of when you calibrate the model. And we are obviously the topic of my PhD was endogeneity risk, so there you go. You're totally spot on that. Yeah, go ahead.
Does your model also work for cryptocurrencies?
We are working on a pilot together with a crypto company. There we have the issue. With the endogeneity. But we're working on that because people are really interested in that. And the day labeling approach really works well because you have a lot of less noise in it. Once something is announced, you have much more traction. People respond to it because there's not so much usual fluctuation in the market price. Anyway, I think we wrapping up quickly. All right. Sorry. Great question. Very good. We are working on that. It's nothing set in stone. We were quite surprised to have this kind of. They approached us. Looking forward to it. Knocking on wood. So what I want you guys, why should you care? I mean, who's working at a bank, at an asset management firm, who's managing money? Oh, very good. You might just want to get my business cards later on, so. Apart from that, why should you care? I mean, obviously, if you are thinking about investing your own money, you might have been caught by surprise by what has happened with Wirecard. And people, this was actually one of the concerns, one of the complaints, that retail investors, especially in Germany, are getting left behind. But we see this as a technology problem. This is not a problem of you guys not doing your homework. This is a problem of you not having access to the right information. And the presentation, let's just talk about the presentation I've shown you. So I've spent a lot of time, doing all those little things here. Put all this information spot on so that you can just look on the slide and have all the information. But this is how it looks like in real life. This is a black line and white canvas. The way stock charts, data visualization in finance is working hasn't changed over the last 200 years. I've looked it up. And this is actually something we are working on. And we want to open source this eventually. Open sourcing in Germany, it's a different matter. But we want to have a JavaScript library that really helps you get all this information, colors, effects, causalities in one place. You click on it, you see it, you're happy. That's something we are working on. And this is where we're not thinking about how can a corporation, how can a big company benefit from what we do, but we are thinking where we see our own problems. So this is actually a design thinking thing we did. And design thinking and data science is something I think personally goes really well. Thank you very much for your time. Risklayo, that's us. For you guys watching on YouTube, there are some left Easter eggs in it. There's one typo in it. If you can find a typo, you might just want to rewatch it and rewatch it and rewatch it. If you find it, get in touch with us. The first one gets a prize. Thanks so much, guys.